first question, based on what we've done in product mix and profitability decision, is what does the width of a product mix refer to? So these ones are the actual questions for the unit. So looking at what does the width of the product mix refer to? So A, the total number of items in the product mix. B, the number of product lines a company carries. C, the number of variants offered for each product. And D, how closely product lines are related. Quite tricky. I hope you can remember this in the questions. So Rufiat, sorry, can you hear me? I think your network had some issues.
Yes, I can. I can hear you.
All right. You're welcome to the call.
Thank you, sir. Good evening.
Welcome. Right. Okay, so you may just have to pick. It's only Julie that was in the class, so you may have to guess what the answer of this is. What does the width of a product mix refer to? So Julie, what's your pick? So I have Rufiat now also on the call.
B.
Yeah, I think Salmat is here now. Salmat is here too. Okay, you are picking the number of product lines a company carries, B. All right. Okay, you're still staying with B like the former time. All right. So Salmat is on the call. What does the width of a product mix refer to? A, the total number. You said?
You could not just give us today as bonus.
No. We don't have time. Today is not bonus. No time. We are running out of time, so we have to run. So no bonus till after ICAN exam. Yes. I want you guys to pass by force. All right. So Julia has taken B as the answer. So Rufiat, Salmat, what's your pick? What does the width of a product mix refer to? A, the total number of items in the product mix. B, the number of product lines a company carries. C, the number of variants offered for each product. D, how closely product lines are related.
I'll go for B. My network.
Okay. So Salmat is going for B also, like Julie.
I'll go for B. B too.
Okay, Rufiat is going with the crowd. All right.
My network has gone. B.
Yeah, I'm hearing you. Can you hear me?
Yes.
Okay. Maybe our network. Yeah, I can hear you.
Can anyone hear me?
Yes, we can hear you.
Okay.
Come.
Here's my pen.
She can hear us, but we can hear her. Maybe she can hear us. Okay. Okay, so Aisha is back. Salmat is back. Okay, so Rufiat, can you hear us?
Okay.
Yes, I can.
Okay, fantastic. All right, Aisha, you're welcome back. Can you hear us?
Thank you, sir. Yes.
Okay. So please make your pick. Please don't sleep off because we want to round off chapter 3 today. So please try and stay awake. Try. We're rounding off chapter 3 today. So what does the width of a product mix refer to? The total number of the items in the product mix, the number of product lines a company carries, the number of variants offered for each product, and how closely product lines are related. So Julie picked B.
Yeah, I was going for that. The number of product lines in the company.
I chose B.
I know. I said you chose B. So virtually almost everybody is choosing B. So I think the popular opinion is B. All right.
I chose
so
B.
You chose.
Anyone here?
Yes, we can hear you. Can hear you, Salman.
Okay,
Yeah, you chose B. All right. Number 2, Which of the following is not a key characteristic of a product mix? The width, the length, market share, consistency. D. Are you sure it's D or B?
C.
B for ball. I picked
C.
B.
C.
She said
A
C,
is
market
going-
share.
Who is going for C? Who is going for B?
I'm going
Aisha
for
is going
C.
for B.
C for
Okay, A
cup.
is going for B.
I'll go
Who
for
is
D.
going for?
D.
Okay, Rufiat is going for D.
C for cup. C. S for C.
Okay, S is going for C. All right, I got it now.
I think
So
Julie
Okay, so
is not here.
C. I said C.
Judy is going
Oh my
for
God.
C. J is going for C.
So
Okay,
it's not
so
a
J
kicker. C.
is not a key characteristic. It's not to look at not. Mhm. Exactly. So R, A, what's your pick? Or what are you going for? A, are you staying with B?
Yes, I am.
Okay, so A is staying with B. J is C. S is staying with C. Then R, what is your pick?
Is she on the call?
Is R there? Her
For
network is
question 2.
fluctuating.
For question 2.
Yes, for question 2.
I've
Because
picked
D.
D. Oh.
You picked D.
Yes.
Okay, so R went for D, S went for C, J went for C, then A went for B. Wow, varying options. Okay, we'll see. All right, so Namesake is back on the call. Sorry, Namesake, can you hear me, please?
Yes, I can hear you. I can hear
Okay,
you.
sorry. All right, nice to have you back. Please, can you confirm if you can see my screen?
Yes, I can see the questions here now. Question
Okay,
1, what
thank you.
does the product refer to?
Exactly. Okay, fantastic. So please make your pick quickly. We've done the 2 questions, so just make your pick quickly. So we'll continue
Okay.
together with question 3. Yes, number 1. What does the width of a product mix refer to? The total number of items in the product mix and the number of product lines a company carries.
Number of product lines a company. Wow, it's like B. Wow. I'm picking
Okay.
B.
Everybody picked B, so you too picked B. All right, so let's look quickly into number 2. Which of the following characteristic is not a key characteristic of a product mix? A, width, B, length, C, market share, and D, consistency.
Either A or B, I'll take A.
Are you sure it's A? Not to. You see, Julie is even helping you. She said not. So
This is not the key characteristic. Market share, yes. Consistency, yes. I like product mix. Okay, product mix. Okay.
It's coming now. It's coming back.
Consistency. Yes, and wow.
Just guess because of time.
Product mix. Market share.
Okay. Final answer is not A. You are sure it's C, not A that you picked first.
A product mix. I thought they were referring to just product, but product mix is a concept on its own. Market share, sir.
Okay. C, final answer. All right, we'll see. Okay, so all of us now, let's go. 5 of us. What is the key factor when making product mix and profitability decision? A, the number of employees in the company. B, deciding whether to add or remove a product line. C, the amount of marketing budget allocated. D, the type of machinery used in production. What is the key factor when making product mix? Okay. G is going for B. Who else is going for B? Somebody else said B.
The answer is B.
S said B.
The S is saying B, okay. Is that R? R is saying B too.
Yes.
What is
Okay,
the
A
key for when
saying
making
B.
product mix?
R said B too, so it's remaining J. We're waiting for J. What is the key factor when making product mix and profitability decision? Number of employees in the company. B, deciding whether to add or remove a product line. C, the amount of marketing budget allocated. D, the type of machinery used in production.
B.
It's B. Yes, huh?
Okay. J
B.
is going for B. All right. We'll see. Everybody went for B. I just hope everybody is now entering the pit. Okay. Why is cost information? Why is cost information important in product mix decision? A, it helps determine the impact of adding or deleting product. B, it decides the company's share price. C, it measures customer satisfaction. D, it controls external competition. Why is cost information important in product mix? Okay, G is going for A. Who else is speaking? Why is cost information?
D is not showing for me. Let me see. Let me expand my screen.
Okay, D is it controls external competition.
Okay. Why is cost information important in product mix?
A.
Why is cost information important in product mix? Okay, who is going for A, S or R? I had somebody say
R.
A now.
Yeah.
Okay, R is going for A. All right.
A
A,
is
what's your
also going
pick?
for A.
Okay.
A, please.
J and
Oh,
S.
J is A.
J is A. Okay, so we're waiting for S now. S is still thinking.
A.
S, what's your pick? Okay, A. Everybody's seem to have the same option. All right, finally, which of the following is an example of product mix consistency? A company adding different types of mobile phones. I like this question. Practical. A manufacturer producing both soft drinks and clothing. I like this one. Technical and application. C, a business offering electronics and bakery products. A company expanding its shoe line into bag and accessories. Which of the following is an example of product mix consistency? A company adding different types of mobile phones. A manufacturer producing both soft drinks and clothing. A business offering electronics and bakery products. A company expanding its shoe line into bags and accessories. Okay, so I had A say something. J says A said something first. A, what's your pick?
I initially picked D, but again, no.
A,
I'm
A.
changing my answer to A.
Even the ash is A.
All right. R said A too or D. R, what's your pick? S, what's your pick? And now I'll definitely take points. I'll definitely pick points in this place. I know. R, what's your pick? S, what's your pick?
A.
Okay, is that R or S? Okay, R is picking A.
It's S.
Okay, S is picking A. All right. So we're waiting for G and R. What are your picks? G and R. Namesake, what's your pick? This one is a technical question. I love it.
I'm for D.
You are going for what?
D. D.
Okay. Okay, G is going with D. All right. So we're waiting for R now. R, are you done brainstorming?
Oh, okay.
Okay. R picked A. Yes, okay. It's S we are waiting for. But S picked A now. I had S say picked A.
Yeah.
So everybody picked A except my namesake.
In between.
I'm looking like D.
You want to change your mind?
No, I can't be doing that.
You can change your mind now. Let me change it for you if you are not going with A.
No, don't confuse us.
Okay, so you are sticking with A. You are sticking with your initial, right?
Yeah.
All right. So namesake D. J is going. J, are you changing your mind? Final answer A.
J. No, F5 is A.
Okay. S, your final answer A.
A. I can give you the example, but when we get to
No. Don't give me example. We'll see. R, are you finally staying with A or we change your mind? Are you there? I hope our network is not.
What do you think?
Is R there?
B.
R is changing her mind to B. Okay. Okay. Are you sure B is the final answer? Final answer B. So that we can move to Judgment Day. R, you're not saying anything. Can we move? You're muted. You're speaking.
Yes, we can move on.
Okay. All right, so let's move Judgment Day now. Number one, what does the weight of a product mix refer to? Wow, incredible. Everybody got it. B. Okay, so the number of product lines a company carries. The weight refers to how many different products a company offers. Even give us an example. For example, a company selling beverages, snacks, and dairy products has a wide product mix. Exactly. So everybody got it. No wrong answer. Nice one. Number two, which of the following is not a key characteristic of a product mix? Market share. Okay. So B, A got it. No, A failed it. A picked B. So A is wrong. The answer is not B. The answer is C. And B is length. Length is the total number of items in a company's product mix. So the answer is not B. You're wrong. So G got it. G said C, market share. Market share refers to the percentage of total sales a company has in a particular industry. It is not a characteristic of product mix. So G got it. J also got it. S also got it. Then R said D. It's because she was not in the class. R was not in the class. So I think A2 was not in the class when we spoke about this. That was right. All right. So those were in the class. They got it. So the answer is not consistency. Consistency describes how closely product lines are related. So the correct answer is C. So G, J, and S got it. Number three, what is the key factor when making product mix and profitability decision? Everybody got it. B. Very good. Declining whether to add or remove a product. One of the main product mix decision is whether to introduce a new product line or discontinue an existing one based on profitability and strategy. Good, fantastic. Number four, A, why is cost information important in product mix decisions? It helps determine the impact of adding or deleting products. Exactly. So that's a good one. Everybody got it. Cost information allows businesses to assess the profitability of their products and make informed decisions about adding, removing, or modifying products. Yes. Okay, so this final tricky pills. Wow, only G got it. Interesting. And did you know it's only G that got 100 over 100? This is incredible. Which of the following is namesake now, Gabriel? Which of the following is an example of product mix consistency? I'm telling you, he scored 100 over 100. The answer is D, and he got it. A company.
And I was looking at that D. I first picked D, then I changed my mind.
Yes, sir.
Like,
You picked D and
when you were talking about this thing, you said Hollandia, like there are different types of Hollandia milk. So how can when making shoe, then you not decide to make bags and accessories?
Yes, now so we're talking of consistency now. Hollandia is the same product line.
But mobile phone is consistency too now.
exactly.
You're talking about Hollandia that they make different type of like the evaporated.
Okay, so
they make that what they call it.
So that's not a mix now. That's okay. So let's go back to the slide. Okay, so let's look at the options. Yeah, so let's look at the options. Then we'll go back to the slide so that we can see the explanation. So for D or for A picked A, and A is not the answer because a company adding different types of mobile phone. This is an example of depth, not consistency, since it's expanding within the same product line.
Okay.
Now, so consistency now looks at this shows consistency between shoes and accessories fall under the fashion industry, making them related in terms of end use and distribution.
Okay.
So a company expanding its shoe line into bags and accessories is showing that it's consistent. Exactly. So J picked A picked A, then R picked B. So
and thank God I still passed.
Yeah, A got 60%. We still go back and look at those options. It's only my namesake that scored 100%. Namesake, I'm not comfortable when people score 100% too. I don't like it. So you are the first person to step on my nerves this night. But anyway, it is what it is. J scored 80%. Ash, you'll have even scored 100% and touched me the more. Yes, so S scored 1, 2, 3, 4. S scored 80% too. Wow. I mean, this technical area, you guys are doing very well. R scored 1, 2, 3. R. Nobody went below 60%. This is good. It shows above average understanding of the subject. Okay, so let's go back for clarity now. Clarity's sake is very important because this area is tested in requirement 2 very well. Okay, so we are back now. Number 1, wheat. Wheat talks about product mix and how different product lines the company carry. So when you talk of wheat, most of us got that answer, number 1. We understand it that, okay, there are different product lines. So for example, Hollandia yogurt, then the yogurt have different varieties. Then if you say Hollandia, another product, say maybe Hollandia rich tea or Hollandia juice, so they are different product lines. But if you say Hollandia yogurt, strawberry, vanilla is the same yogurt, but the same length, number of items the company holds in that same product mix, but different flavors, so that's the length. Now coming to the depth. Depth of product mix refers to how many variants are offered of each product in the line. So for example, I use Promasidor, and I said cowbell has cowbell coffee, strawberry, this. Then there's another one called Texco, the Tempo, one beverage under that same line. So they have different variants on the product line. And that's the example of depth. So where we have issue now is consistency. So we said consistency of the product refers to how closely the various product lines are related in end use. So you see, production requirement, distribution channels, or some other ways. So it's the end use now that the example of shoe and accessories came to mind. So let's look at the question again. Which of the following is an example of product mix consistency? So A is a company adding different types of mobile phones. So B, a manufacturer produces both soft drinks and clothing. A business offering electronics and bakery products. A company expanding its shoe line into bags and accessories. So this is the end use now that validates D as the answer. And that's why we have, yeah, please go ahead. Somebody wants to say something. So namesake, why did you pick D? You sounded as if you really knew the answer. Why? Can you explain to us?
Not quite. I was looking at the nature and the classes of products that are there. That was all. That was just what I considered. Shoe, this leather. You talk about where is it again? Sorry. You talk about shoe is leather. You talk about bag is leather. And then accessories, so these are just the things I put together.
Yeah, good thoughts.
Nice thoughts.
Nice thoughts. Yeah, nice thoughts. So Salmat, you are trying to contest it. So are you okay now, or you still have either Salmat or Rufiat? Are you okay with it, or you still have doubts?
I am just sad.
Why now?
Don't be sad, don't worry. Yeah, don't be sad. You will do better in the last, this last session we are moving into. We are wrapping up chapter 3. So please pay attention and don't sleep so that you can give it a bang before we move to chapter 4. So that's a good one. Everybody did above average and it's good. And our prayer is that you do above average 60 to 80, but don't score 100 in case study. Don't do 100 over 100 so that the examiner will not think you cheated or something, you know. Score your 80, score your 60 and move. All right, so we're looking at project appraisal down to using financial data analysis in the case study exam. So like I said, we'll be running. It's a summary of everything. We can't take it at that slow pace now. There's no time. Because in the month of April, we should be able to stop at the end of April, everything lectures. And within that same April, we are looking at mock exams. We have one mock we have not submitted up till now. So please, you guys should submit your mock because we'll be looking at mock exam 2 debrief on Thursday. So please submit by Wednesday midnight. I know it's not easy, commitments. I understand absolutely. But please push yourself, try so that we can do the debrief. Because by Monday, the 3rd mock is coming up. Somebody said on the platform, won't we rest? I say, yes, you will rest after May 2025. So please push yourselves. Exactly. So please push yourself and give it that last bang. Let's see how to make passing case study and the other papers memorable. Okay, so let's run. We'll run and end chapter 3 today so that by next week we'll enter chapter 4 and start very fast. So we're looking at project appraisal, a very important part of requirement 2, where this examiner pimps very, very purposely. Mostly requirement 2 comes under project appraisal and candidates must use this appraisal specified in the exam or those most suitable to the provided data. So most of the time he gives you an appraisal technique, NPV, profitability index, whatever high-low method, comes up with all kinds of appraisal techniques, but you must use what he asks you. And if he does, it's not specific, you use based on your discretion and your judgment with the provided data in the exhibit. So avoid introducing extraneous assumptions or calculations not requested. Extraneous means what is outside the case. So focus on payback period, average return, ARR. ARR is, what's the acronym again for ARR? Somebody should remind me. Somebody remind me now. SFM people, ARR. I know IRR is initial rate of return. Accounting rate of return. Thank you. Yes, accounting rate of return. I know it's not average, it's accounting rate of return where you don't discount exactly.
The discount is where you don't discount exactly.
Yes, you don't discount. Thank you, Jay, for that. So focus on payback period, the amount of time to recoup your money back. Accounting rate of return is almost the same thing as return on capital employed because you don't discount. Then the net present value has discounting factor. The IRR looks at the interpolation method where you have a low discount rate and a higher discount rate, and also profitability index, discounted techniques to check. So most of these techniques, we've looked at them in performance management, some of them in SFM. So they will feature in mostly requirement 2 purposely to, I will not say waste your time, but to test your understanding and also take some of your time. But if you're able to basically do some of these calculations, don't concentrate on detail or more calculations so you don't waste your time and write. So like I said, the mock exam 2 is there. Please write and write and write. Write very much to end mark. Don't discuss scantily. Please write irrespective of whatever you've calculated. Have a base. Any of these techniques tested, please write. Very important, write. Also prioritize using the required method over personal preferences. So personal preferences means a method you are good at. So you may be good at NPV, you're not good at ARR. You may be good at payback period, you may not be good at IRR. So what happens is the first thing is please stick to the examiner's technique or his instruction. If he says use this, use it. If he doesn't say use this and he says use a suitable model or a suitable technique, go ahead and use what is suitable to you, but then let it be within the context of the case. If ARR will not calculate your requirement 2, based on the parameters and the data provided, please use the one appropriate. If you are given a discounted cash flow, a hurdle rate, or a discounted percentage, you know ARR cannot work, even if you know ARR better. So MPV will be better, and that's what he tests most in his exams. So prioritize using the required method over your personal preference. Very important. Okay, so decision making. We're looking at decision making in using financial data analysis. One of the key components of financial data analysis is decision, operational and tactical. That's within middle management. Then long-term and strategic decision belongs to upper management. So decision making is very important, and that's why when you make your computations, you make decisions after the elaborations and conclude, and you make your recommendations. So decision making is key. You have short-term decisions within a month, 1 month, 2 months, 3 months, quarter. Short-term decision focus on relevant cash flows like future incremental, opportunity cost, ignoring sunk cost, and non-cash items. So we have incremental costs that roll over month by month, and they are futuristic in approach on a monthly basis. Opportunity costs are the alternatives you forgo to bear a particular cost. Very important to take note. So what if you are forgoing this cost? What's the cost savings? That's the opportunity you have, either in reduced cost or reduced opportunity. Also ignore sunk costs. Sunk costs as costs you can't do anything about. They just sink into the activity. And also non-cash items like depreciation and amortization. So ignore these costs as short-term decisions in decision making. Long-term decision making impact overall business objectives, requiring strategic planning and consideration of the time value of money. This is very important. So the value of 5 naira today cannot be the same value of 5 naira in the next 5 years or 10 years. And that's why the time value of money comes in. So time value of money looks at the length of time the value of that currency or that amount will yield in the market over time. And that is strategic and long term. It's not a 1 year thing. The time value of money does not build or yield up in 1 year. It does over 5, 10, 15, 20 years. The value of 100 naira 20 years ago is not the value of 100 naira now. In our country and other countries, possibly depending on the rate of the devaluation. In Nigeria, the value of 100 naira in 20 years before now has eroded drastically. So the consideration of time value of money in decision making and also these our computations is very important. And that's why effective interest rate, hurdle rates come in percentage to increase or spark up the amounts you get for your money over time. So balance short-term and long-term impacts using tools like balance scorecard is very important. So the balancing of your short-term and long-term decisions is very important. So your 1 year decision short-term, your 5 years to 10 years decision long-term, you can balance it with balance scorecard. Balance scorecard has 4 perspectives. So the first one is the financial. The second one is operational. Third one is customer. Then the fifth one is people, staff. So you look at financial aspect or perspective, and you look at customer perspective, and you look at operational perspective, and you look at your staffing, the people perspective. So that's the balance scorecard. When making decisions, you should think of these 4 areas. The examiner has tested balance scorecard in former previous editions of the case study exam, balance scorecard. So I think I've solved that question. You can go back to the YouTube channel to look at how balance scorecard is applied in that requirement 2 question. It's important to understand this model. It's a model and a very good model, practical and applicable in practice. Okay, so the next one is risk and uncertainty. Uncertainty is when you lack information. You don't know what to do. Reduced through information gathering like market research. So uncertainty comes when there's no information, but you have some degree of certainty when you have information gathered for market research, development, and all that. So risk is danger. There could be threat, and risk could also be opportunity. So what do you do to opportunity? You explore it. What do you do to risk? You mitigate it. Threats, you mitigate threats, and for opportunity or risks, you explore it. You explore opportunities bearing risk in mind. So risk refer to events, probable outcomes analyzed statistically. You analyze risk based on statistics and trends. You also consider expected incremental costs that roll over monthly, also revenues and profits along risk. So how does risk impact your costs, your revenue, and your profit? This is very important. So in whatever decision you're making in your organization based on cost, revenue, and profit, look at the risk of a threat eroding whatever plans you have, and what also opportunities you have to explore revenue and profits in terms of opportunity and the risk, positive risks. So understanding risk preferences, like being risk averse. Being risk averse means doing nothing about the risk. If a risk is showing up, whether opportunity or threat, you do nothing. That's what it means to be averse. And also being neutral is not doing anything about the risks, but just watching. You are being neutral. You don't want to make a decision positive or negative. It's different from being averse about doing nothing. And also you are seeking risk, like your appetite, the risk appetite, how much risk you can take to achieve a particular objective is risk seeking. And that's understanding risk preferences. So in the sixth component, or the sixth header, we have evaluative judgment, evaluative skills and judgment, where you write under evaluative skills and judgment. So that area looks at risk, positive and negative, on the exhibits. So that header is very important. You apply this lecture to that header. Also use expected values and decision trees to analyze risks. So expected values as you've planned, and decision tree, looking at antecedents and what have happened based on the trajectory of events in the past. Use it to analyze risk and make decisions for the future. So expected value are mostly made on, expected value decisions are made mostly on data provided in the past historical data. And you look at decision trees that has been made in the past to analyze the risk of whatever outcomes that have happened in the past to mitigate the future. It's very, very important. Also, the value of perfect information in decision making. No information is perfect. There's one or two issues with every information, but the amount a manager is willing to pay for certainty on that information is also key. So there are some chartered accountants that produce very good outcomes information, and there are some that don't have that requisite skill. So the difference between an ACA and somebody that just have BSc is clear. You can't compare it. Somebody that went through the ICAN curriculum will produce better information than somebody that just have BSc. The BSc program in accounting or HND is not rich enough to produce the kind of expertise a chartered accountant will provide in the office. They are two ways apart, two wide worlds apart. So the information a chartered accountant will provide will be more cleaner and perfect than that of a BSc graduate or an OND graduate. That's what we're looking at here. So the perfect information or quality information is the amount a manager is willing to pay for that skill for the person that will provide it. Also looking at sensitivity analysis, you test the effect of changes in key variables on the decision outcome. So there is information provided, but how true is it? How true is that information? What is the certainty of those information? And that's where sensitivity analysis comes in, where you perform tests on those variables based on parameters and performance management tools to make decision on those variables. And that's what sensitivity analysis is all about. Then most of the decision making comes in form of business and investment valuations.
Analysis.
Yes, please. Yes, please.
Okay.
Please feel free to interject. Yeah. We want a bit of clarity on sensitivity analysis.
The key variables on decision outcomes, like.
Exactly. So like sales price minus variable cost. That one is your your contribution analysis or contribution margin formula. So the key variable is your price in the market, and the variable cost are those indirect expenses like admin and selling. So you want to be sure that the selling price is what is charged. You now test that selling price, and you also test the variable cost. And that's what sensitivity analysis means. Those two variables are sensitive. So you are testing them to see this selling price that they charge 5 naira. Is it correct? And the variable cost that is 3 naira. Is it correct? So the outcome of that price based on the decision made by management, and also the outcome of the variable cost made available by management is what you are testing to see how sensitive those two variables. And there are key variables in determining contribution margin, and that's what sensitivity analysis is all about. So where those prices, for example, selling price moves to 10 naira, you will test why it moved to 10 naira. What is the change between 5 naira and 10 naira? What sparked or what spurred that decision to move from 5 naira to 10 naira? Is it the cost? Is it fixed cost? Based on the decision outcome, and that's why it's sensitive. Those decisions are sensitive, and that's what is called sensitivity analysis. I hope I'm a bit clear on that. Hello, A, are you there?
Yes, it's very okay. Thank you so much.
Okay, you're welcome. Okay, so looking at business and investment valuation, which mostly comes in requirement 2. What is the purpose of that valuation? You want to value a business to either buy it, take it over, make bids to take it over, or unquoted companies trying to get quotation, initial public offers for shares, or they want to be quoted from being limited by guarantee or limited by shares. Initial public offers, private sales, mergers and acquisitions, estate tax. These are reasons or the purpose for valuation. Quoted companies, takeover bids, and these are business and investment decisions that are strategic and for senior management. And you make those decisions either in requirement 2. There are questions on mergers and acquisitions. He has tested in former or previous editions of his questions. So business and investment valuation is very important, and you use some models in making those business and investment valuation. You use valuation models. He has tested some in the past, like he has tested the growth model. There's the asset-based model where you have your net asset value, net asset realizable after you've sold the company, and net asset replacement value, what you have after you've replaced an asset, what are the proceeds. We also have another valuation method based on market-based valuation technique, looking at the price earning ratio that we looked at in investment ratio. You want to purchase or buy another business, you have to check the viability of their price to earning ratio, look at their earnings yield. What is the earnings per share compared to the market price per share? The dividend yield, what is the dividend per share compared to the market price per share? Also, another technique using you can use is cash flow based. Discounted cash flow, like the net present value, is a good cash flow base where you have cash flows and you discount it to have your present value. You have also a net present value looking at your initial outlay deducted from your cash flow for the number of years. So these are valuation techniques, and they are very good and they're applicable. The examiner asks you to test or use them in working out most of your requirement 2 and make decisions on them. Also, the EVA analysis, where you have the net operating profit after tax and you have some other variables as expenses, is also a model we'll look at subsequently. We also have the net asset value, book value of net tangible asset only, not intangibles now. It's also a method. You only value your tangible assets outside your intangibles like goodwill, copyright, patent, and co. You also have net asset realizable value, and this is a liquidation value. After the company has filed for bankruptcy, is liquidated, restrictive covenants and interest-based creditors or capital providers have taken their share, and the remaining is what is realized for ordinary shareholders. So those are all valuation method. We also have the current replacement cost. In looking at your net asset replacement value, what is the current cost of replacing that asset? There are limitations which include the omission of intangible assets to these models. The models assume that intangible assets are not significant or a requisite for decision on those assets. They just believe intangible assets don't have cash-based valuation. You can sell physical asset, but how do you see goodwill? How do you quantify goodwill? How do you value goodwill? And those are part of the limitations. But then intangible assets like goodwill exist. Very important. Also, we have income-based valuations that we've looked at, like the PE ratio, looking at your market price per share divided by your earnings per share, and using comparable quoted companies in the same industry. So, for example, I used Bois PLC, Bois Cement, and the Dangote Cement. So, when you are comparing the value of Bois Cement and Dangote Cement, or Bois Sugar and Dangote Sugar, you can use the PE ratio of both companies to compare these quoted companies' profitability. Also, the earnings yield, looking at the earnings per share divided by the market price per share, adjusting for private company risk. What is the risk that the variations in this price and the earnings of the company in particular periods are actually stable and correctly valued? So these are income-based valuations decision that you also make. The dividend yield is your dividend per share divided by the market price per share, adjusted for private company risks also. The dividend earned by shareholders, ordinary shareholders, and compared to the market value of those their shares, adjusting for any company risk and fluctuations, is very important in also decision making in the case study exams. We also have dividend valuation method like constant dividend, growth dividend model. We have Gordon's model. All this you've tested in your SFM and you've looked at. It may likely be featured in case study. He has featured it in November 2014, where he tested our growth model, DE plus growth. Those formulas, you can still remember them. So calculations are a starting point. Context and judgment plus conclusions and recommendations are also vital. So the base or the foundation is calculation. Then your discussion is based on your judgment, and then your conclusions and recommendations are vital. When you talk of vital, they are very, very important. So in financial data analysis, mostly they come in requirement 2, not a hard and fast rule anyway. You look at the May 2016 exams we did, you see that he tested financial statements looking at gearing in requirement 2, and he only brought SWOT in requirement 1. So that he predominantly brings financial statement evaluation in requirement 1 does not mean that's what he will do every diet. So be sensitive to his requirement and read it, reread it to be sure that's what he has or wants you to do. Also provided information, maintain consistent denominations and label figures. So the denomination, if it's dollar, if it's naira, predominantly it's the naira, the question comes in. Maintain those denominations in your calculations. Put them as the top identification of the currency you are using. Some people just write figures and forget the currency. There are marks allocated to that. So from the information provided, be consistent with your denomination and label your figures appropriately. So perform sense check to avoid basic error. So have your calculator. punch your calculator, be sure. Don't just say 1 + 1 is 2. Under exam condition, you can write 1 + 1 is 5. So please use your calculator and be sure what you are punching because of tension and also the time you are rushing to meet up with. Also, assumptions, evaluation in your financial data analysis. Identify and question assumptions in financial data. Justify any adjustments. Also, where you need to pass adjustments, do that. And more importantly, professional skepticism to information sources. Question the information. So even under requirement 2, you have ethical issues to discuss. Very important. So question data, also question the financial information, question other issues, point out ethical issues because it's very important also in requirement 2 as a separate header. The information should be purposeful, precise. Every prediction, problem, priorities, and perspectives should be questioned skeptically. You are a skeptic. Now, looking at the numbers reflex and sensitivity analysis, adjust numbers based on errors you notice or changing assumptions. So where there are errors, like I spoke about the contribution margin formula, for example, you can adjust it or perform sensitivity analysis to change any assumptions and use sensitivity analysis to assess the impact of variable changes. Are they material or immaterial? What caused the move or change? Also comment on the likely impact of adjustments, even without full calculation. Exactly. So make very brief comments in your appendices and integrate those comments into your discursive work. This is very important. It shows the examiner you are adding input and clarity to what you are asked to do. And also plausibility and numerical output. You balance your accuracy and speed, materiality, and also perform your summary. So plausibility means your balance, maintaining accuracy to some extent, and please be fast. You don't have much time, so be very fast. And materiality talks about the size and amount of what you are calculating, and also perform summaries. Ensure your output is appropriate and clearly explained. Very important. Choose appropriate reporting formats, the appendix or the body. So about appendix should be referenced. So where you've calculated your NPV, in your discursive element based on your headers and subheaders, you reference the appendix. So you've spoken about the NPV, the cash flows, you've discussed it. In bracket, see appendix in the body of your reporting. This is very important. Now, as you are interpreting and reconciling your accounts or your calculations, explain the meaning of the calculations and the results. As you're discussing, provide answers to why and so what questions. So the requirement has provided you with the question what to do. Then every other question that rings from the exhibit, please provide answers to them in form of your narration and description. Very important. So the whys of the case, please answer them. Also the what, so what of the questions, please answer them. Very important. Then you need to make financial decisions. And this is the crux of the matter, which is conclusions and recommendations must follow logically from the analysis. Highlight reservations, parameters, but provide clear advice in form of recommendations. It must follow logically from your analysis, your calculations, and your discussions. This is very important. So, in summary, in the case study, we apply appropriate analytical tools, provide context and rationale to what we've analyzed, exercise our judgment and materiality. Then we construct clear appendices as the calculations, evaluate our assumptions and apply professional skepticism in summary, use sensitivity and crunch the numbers. Also, don't forget to consider wider context, the external environment, inflation, the economy, fiscal policies, generally that impacts the business environment. Also, construct a logical report with clear explanation. Conveniently use financial techniques that are appropriate or asked in the requirement, and also justify the choosing techniques if you are not asked or you are asked to choose appropriately. And also arrived at well-supported decisions based on your conclusion and your recommendation. Then you communicate your analysis effectively. Communication is key, and that is writing clearly, legibly, and in detail for the body of the work so that you can pick your marks and also communicate your thoughts effectively. This is very important. So that's the summary form of your financial data analysis. That will be the chapter 3 of what we'll see. So this theoretical aspect will only be practicalized as we look at the mock. We will not have time to do all the calculations in this lecture section. So the mock will provide us an avenue and also the debrief sessions to look at how to apply what we've learned in the financial data analysis in those mock exams. So like this mock exam 2, where we have best price fashion case, the requirement 2 graphically aligns with some of these things we've discussed here. So on Thursday, we'll be looking at the debrief. So please submit your mock exam 2 by Wednesday midnight, please, so that we can trash it out on Thursday. We'll also look at the discursive element and the calculations on Thursday very fast so that we can end up mock 2 and prepare for mock exam 3. All right. I hope we've not slept off all this while I've been speaking. I know we are tired. What's the time now? Wow, this is 10 on the dot. Let me see how many people are on the call. Everybody is quiet. All right, namesake, Aisha, and Julie. I hope you guys didn't sleep off as I was speaking. I know. Namesake, are you there, Aisha? Or are you guys, you wake up or I'm done? You may have to go back to the video. It's time for our final quiz question. Are you guys there?
Yes.
I can only hear Julie's voice. I can hear Julie now. I've not had. Namesake, you are muted if you are speaking. Aisha, you are muted if you are speaking. Salmat, Rufiat, they are no longer on the call. Aisha can hear. Namesake, are you there? Okay, Aisha can hear. All right, Aisha. Okay, namesake, if you are speaking, you are muted. All right, so let's run through the quiz so that we can go and rest quickly. We've had a long day. Okay, so number 1, which of the following is not a key consideration in short-term decision making? Relevant future cash flows, incremental costs, opportunity costs, and sunk costs. So I have A, I have J, and I have G. Which of the following is not a key consideration in short-term decision making?
I'll go with A, relevant future cash flows.
A is going with A, our initials. All right. J, what are you going with?
With D.
Sunk cost, D. All right, namesake, what are you going with? Namesake is muted. He has. All right, number 2. In business valuation, which method focuses on estimating the value of a company based on expected future cash flow? A, net asset value. B, market-based valuation. C, discounted cash flow. And D, earnings yield. In business valuation, which method focuses on estimating the value of a company based on expected cash flow? A, net asset value. B, market-based valuation. C, discounted cash flow. And D, earnings yield. That's our pick. J, what's your pick? A, what's your pick?
Future cash flows. Future cash flow. Discounted cash flow. How much present value?
Business valuation, which method focusing? Okay.
Market-based valuation.
You're going for B, final answer.
Yes.
Value of a company based on expected future cash flow. No, is it that A or B? Net asset value.
Okay. We have to eliminate one now.
I think it's B, market-based valuation, B.
Okay. A is going for B. J is going for B also. All right, we'll see. Number 3, which of the following techniques is not a discounted project appraisal method? Payback period, net present value, internal rate of return, profitability index. Okay, payback period. J is saying A. Final answer.
Yeah.
Okay. A, what's your pick? Are you going for A2 or you have a differing opinion? A, you are muted. You are speaking. Which of the following technique is not a discounted project appraisal method?
I forgot how profitability index looks like. I'm not sure.
Okay, so you are picking D.
I will go for D. Yeah.
So you want to change. You want to join
between
Julie
A and D, but I'll go for D.
Okay, we'll see. When performing sensitivity analysis, what is the main objective? A, to eliminate all risks in decision making. B, to assess how changes in key variables impact the decision outcome. C, to replace assumptions with perfect information. D, to predict future stock prices accurately. When performing sensitivity analysis, what is the main objective? Second to the last.
C.
To replace assumptions with perfect information. Final answer.
Yes.
J is picking C. A, what's your pick?
I'm actually picking B.
Okay. A is picking B. Final answer. All right. And finally, the value of perfect information in decision making refers to the cost of gathering market research, the amount a manager is willing to pay to eliminate uncertainty, the expected return on investment from a new project, the sensitivity of a project's cash flow to market fluctuations. The value of perfect information in decision making refers to A, the cost of gathering market research, B, the amount a manager is willing to pay to eliminate uncertainty, C, the expected return on, okay, J is picking B. A, what are you picking?
C, actually.
Okay. A is picking C. All right, so let's go. Let's see judgment day.
Yeah, this one was quite, I don't know.
Yeah, you guys were dozing off. Sleep was dealing with you people. That was right.
Honestly, when you explain that sensitivity analysis, even though I know I asked the question,
even that sensitivity itself, it's been long, and it's just a budget used to answer questions. Okay.
All right, number 1, which of the following is not a key consideration in short-term decision making? Yeah, so J got it. D. So A failed it. She took A. So some costs are past costs, exactly, that have already been incurred and cannot be recovered. They are irrelevant for short-term decision making because short-term decision making are futuristic. Exactly. So A, relevant future cash flows you picked. Correct consideration because short-term decisions focus on future, not past cash flows. Exactly. So A is wrong. The answer is D, and J got it. Okay, so let's go. I know certainly not you people will not score 100 in this one, I'm sure. Sleep was the factor.
Oh my goodness.
Sleep is the factor. So number 2, in business value valuation. When you said, I said people were sleeping because when you hear future cash flows, you just know that it's discounted cash flow. After your outlay, the next thing is your cash flows now, and it's future. Yeah. And you have a discounted cash flow that is your hurdle rate. So both of you picked B. You picked B.
When I saw market valuation, when I saw the business valuation,
you were influenced by sleep. It was sleep. Sleep has been sleep made you drop points, but it's fine. So discounted cash flow values a business by estimating future cash flows, discounting them to their present value. Exactly. So you both picked B.
But you know, this discounted cash flow is for present value. But when you now said expected future cash flow.
Expected future cash flow, yes. Because I know
that's what that's what, if you are saying present value.
Present value.
Expected future cash flow and discounted, I don't know, I was just a bit confused.
Honestly, me too. But I thought expected cash flow had its own formula, like
But the question didn't test formula now. What he's saying is the business valuation. You are valuing a business. You are valuing a business based on now and future now. That's what you are doing. And the percentage of discounted or the hurdle rate given to you is to determine whether the value of the business now and forecasting what will be in 5 years, in 10 years. So the question is in order. I didn't ask you for formula. So you were thinking technicality, while the question was basic. The question was basic. He said, which method focuses on estimating the value of the company? So now and future. He didn't say which formula to use. So
and when he said value of the company, I now say I went back to SFM, and the value of company was net asset value, market-based valuation, all those things, So that discounted cash flow
went honestly.
Exactly. So when you hear discounted cash flow, you hear present value, future value, they're all the same. You're just determining now and in future based on the time value of money. Exactly. So when you say market-based valuation, you're looking at investment ratios like the price earning ratio, dividends, yield, the earning yield, and it has nothing to do with future cash flow. So market-based valuation, so market-based valuation depends on the price of the shares and the company value on the stock exchange. That's what it means. So take note of it. So the answer is C, and you still drop points. So I'm going home with a lot of your points today.
It's due to sleep.
Yeah, it's due to sleep. I know, I understand. Which of the following techniques is not a discounted project appraisal method? I was surprised when Jay picked B, because I was like, why will you pick B? But then, sorry.
I said A.
Did you pick A? Okay.
I said
yes. Yes, you picked A, exactly. It was it was A that picked D. Yeah, so you picked D. You picked D. So the answer is
I
said payback period.
Yeah, I can see it now. Jay, you got it. So payback period calculates the time required to recover an investment, but does not consider the time value of money.
Yes.
And profitability index uses discounted cash flows to access the project's viability. So profitability index, IRR, and MPV are all discounted cash flow or appraisal methods, but payback period is not. So take note A, even though I know you know it, but it was sleep that was the factor. Number 4, when performing sensitivity analysis, what is the main objective? A got it. A has gotten her final point now. And G failed this one.
5 out of 4.
So when performing sensitivity analysis,
what did they even say?
Pick C, you said to replace assumptions with perfect information. There's nothing like perfect information in accounting.
Yeah.
It's rarely available. You don't have it. So to assess changes, so sensitivity is changes in key variables impacting decision outcomes. It evaluates how different assumptions, cost, revenue, discount rates affect the final decision. Exactly. Okay, so finally, the value of perfect information in decision making refers to, Jay got it. Jay tried 60%. This is the lowest. This is the lowest A has gone so far. Lowest, 20%. A she was tormented by sleep. Tormented.
This was a threat.
Yeah, real threat. Negative threat, in fact.
This is SFM for you.
Yes, exactly. This is SFM. So at least we've summarized financial data analysis. We are moving to business reorganization and capital reconstruction next week. In fact,